So there's been a shift in the tone from the Federal Reserve recently, or I should say from a couple of Federal Reserve members recently. And that shift has come out from, for example, Fed Logan, from the Vice President of the Federal Reserve, from Bostic, Waller, you could argue, a little bit, but not much comments on monetary policy in its last speech. But you're basically getting the shift from many of these Fed members. Oh, and I forgot to also mention Fed Daily talking about where rate hikes are or could be headed towards. Now, before I get into that, my name is Daniel. I run an organization called Infovest. Infovest promotes financial literacy, teaches you about the financial markets, oil, stocks, bonds, commodities, currencies, crypto, and so on. If you're interested, check out the website. The link is in the description for you to read up on it. Now, let's get into it. Let's talk about the Fed members that came out. What did they say exactly that shifted the tone in both the bond market and the stock market, right? So what they came out, what was really important is they came out and stressed that the long end bond yields basically did a lot of tightening for them. And many of the Fed members also suggested that they might be done in terms of raising rates because of what has happened on the long end of the bond market. If you remember, I did a video just last week where I talked about the bond market, especially the long end, hitting the 5% level. And ever since then, the yields have been coming down from that 5% level. It's been dropping, which means bond prices have been going up, right? So it's very interesting that the Fed members have come out and they said that, they've done the bond market, those yields have done the tightening for them. We're watching that. Although we still have to fight inflation, we still need to bring inflation down. We're not done in tackling the inflation beast. But yes, the long end bond yields did do some tightening for us. And it might be, time to start thinking about pausing or not raising rates further, at least for this year. So that extra rate hike that was penciled in from the Federal Reserve for this year, one more rate hike, may not actually happen as long as inflation doesn't exacerbate or go wild in the next coming months. And if that's the case, then it's very likely that the Fed might actually be done here. Now, could they hike next year? Sure, definitely, right? Could they continue the pause next year and hold rates where they are for the whole year? Sure, definitely, right? But generally, whenever the Fed comes out and they start to pause, the next move after is to cut rates. And that's why you saw bonds and stocks both go up. Gold also went up because of the dovishness that came out from the Federal Reserve. And I talked about this even in my gold video where I said gold is not going to go up until you get the dovishness from the Federal Reserve, right? Until the tightening is starting to end, right? Although they're still doing QT and they're still tightening, and they're not easing, but this is the beginning of when easing could come down the road. And that's just by simply pausing rates. Again, unless something happens in terms of the inflation, the CPI, and so on, where in the next coming months, it pops and gets hotter and hotter. Oil all of a sudden spikes up. There's a hot war or something, right, with Iran, and shortages of oil continues to get worse off, and oil goes to $100 a barrel or higher, then yes, sure, then you obviously see a reaction from the Federal Reserve and also the bond market as well. So we're starting to see those yields come down. Bond prices start to go up. We're starting to also see the yield curve basically flatten again. It was steepening the whole time, but now it's flattening because it's being driven by the long end. The long end is moving more higher in terms of the prices, which makes me think that if the long end bond yields were doing the tightening, and they're now no more doing the tightening because because we're moving away from that 5% level, and it creates kind of easing conditions. Does that mean that the Fed has to now come back and hike and tighten further, right? Because they acknowledge that the 5% or the high yields is restrictive and is doing their job. And now if those bond yields come down and come down further, and growth continues to be strong, inflation is not coming down, then hey, things can shift and change very, very fast. So they could be signaling a pause this year, and then next year go back to hiking again. So that's why it's not, you got to be really careful, because it's not exactly clear where the Fed wants to go, although they're saying it in their message. But it can definitely change if those bond yields come down and you get a spike of inflation or growth coming back in, job market still doing well, then that changes everything. Then they can go back to hiking again, which will throw the market off guard, and maybe even the bond market as well, right? So it's very interesting to see how this is playing out, and it'll be very interesting to see how, especially by the end of this year and next year, as they come up with more remarks about monetary policy, and most importantly how the data shapes out. It'll be interesting to see what they do in terms of their rate hikes and how that affects the economy, unless they're pausing because they see something coming down the pipeline very soon, maybe 6 months from now. Recession, credit events, something that they see that we don't see, that they have to now pause, right? Because I'll tell you this right now, they're not cutting rates anytime soon, especially with the current numbers that are coming out and how the economy is looking. There's no reason to do that, because you'll bring back the inflation beast. And this inflation beast was also mentioned recently from the European Central Bank, the ECB. The ECB came out and said that, hey, we are thinking about a pause. So again, you're hearing the central banks around the world globally coordinating with each other, thinking about a pause, but don't think that we're done in controlling the inflation beast. So you may be happy that, hey, woohoo, a pause is coming, but inflation picks back up, the beast comes back, then it's a big problem. They go back to hiking again. And if those bond yields are creating the easing conditions and not fighting that inflation well enough, again, next year they could go back to hiking, unless the bond market or the Fed sees a big credit event coming around the corner very soon. And we will see. We will see in about 6 months' time why they paused, or if they're pausing, or if they continue to pause and really say that they're not hiking anymore. We will see the reason why. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.